So as I said, the second point that we have to look at in our um, in this chapter is the relationship between the performance evaluation system and the kind of decisions that the manager will make. Okay, so in this particular case, we have three divisions, and they have two possible ways of being evaluated. Okay, so you can evaluate the manager based on ROI, or you can evaluate the manager based on RI. And the question is, what is the decision that they will make? Okay, so we're going to go through this. So they have to borrow the money at the minimum. So I made this sort of, so this is just interest rate as RRR. They have to borrow 3 million at the minimum rate of return, right? So you can think of this here as the interest they have to pay the bank in order to borrow the money. The question is, which manager will decide to do this project and which manager will not decide to do the project? You've got to remember that the manager is being evaluated based on ROI, and the higher her ROI, the more she's going to get at the Christmas bonus. So I'd like you to look through this. Okay, so first I would like you to see what the current ROI is. I'll give you a few minutes to look through this. What is the current ROI? What is the ROI if the project is accepted? What is the current RI? What is the RI if the project is accepted? Okay? Just make sure that you are clear on this. But okay, I don't know, I'm doing this in my head, so it might be a little mistake here and there. Well, okay. Okay, let's go through here what we have. Here we have 20%, everybody okay with that? 600,000 divided by 3 million. Yeah, that's 20%. Go to the next one is 560,000 divided by 7 million is 8%. Yeah,
Right.
560,000 is our income,
Okay.
7 million is our assets. Yeah, 8%. Okay, and here we have 5,800,000, so it's exactly 16%. Yeah, if you add the two together, if you take the new project, let's just maybe do a calculation here. The first one, we will have 3 million, I'll leave the plus 3 million, this is our investment. Oops. Investment and 600 plus 450 equals 1050. Everybody okay with that?
So it's the $3 million,
We have 600,000 already.
right?
And if you take the new project, we'll get another 450,000.
Right.
So you add the two up, you're going to get 1,050,000.
And you
Okay.
added 3,000.
I've
3
done
million
this.
worth of
So you have
investment.
$3 million, you have a $3 million investment, so you're
Yeah.
increasing your assets by 3
Right,
million.
6 million. So the total investment is 6 million, your total income is 1050, you divide one by the other, you get 17.5. Very okay, let me just write it. ROI equals 1050 divided by 6 million, which is equal to 17.5%. Any questions on this? We're just doing, if you put the two together, you get the two incomes together, you get the two investments together. Okay. I'm doing the same thing in the other two also. So here, maybe I can just type in the square. This is equal to 1010. That's the total income. You add the two up, the 560 and the 450 gives you 1010. And you have to divide by what? 7 plus
10.
3. Yeah.
$10.10?
560 plus 450.
Oh, okay.
And
Divide by
this
10
one
million.
is going to be equal to 800 plus 450 is 1250 divided by 8,000.
15.65.
I'm sorry?
Instead of 12, it should be 15. 12.6.
Oh,
15.65.
15.65,
Yes.
sorry, yeah, thank you. So let me just pause here for a minute. So which manager will accept the project? Will the manager of A accept the project? Remember, the bonus depends on their ROI. No. Their ROI goes down, you know, no toys for the kiddies this year, okay? So, this is a problem, okay? What about B?
Yeah,
Yes, we will accept it. Okay? And what about C?
reject.
The ROI goes down. Okay, so in this sort of slightly simplified world, this is how it works. Okay? This is how it works. You have the ROI, if the project is accepted, if the ROI goes up, they will accept the project. If it goes down, they won't accept the project. So if they are rewarded based on ROI, A and C will refuse the project, and B will accept the project.
Even though in A, you're still making some money, even though your ROI is being
Yeah, that's the thing.
So
That's the
that
whole
depends on
point.
the
That's where we are going.
opportunity
Okay,
cost
that's
of-
where we are going.
Just go back, I'm sorry, I'm not following, I'm frustrated.
Which one? The RI or the
On
RO?
C, if the ROI if the project is accepted,
Right. If the project is accepted, the ROI goes up to 10.1, and they're currently at 8.
then I get, okay, I just need the calculation, I need to walk through the
Okay,
calculation.
the calculation, sure.
So, why-
Okay, so let me go here, let me write it down here. Let me do it. Okay. So, originally, we have 560,000, let me write all the numbers, divided by 7 million. Equals 8%.
Oh, okay. I just divided.
Now, if you accept the project, we have 560,000 plus 450,000. And can you tell me what the total investment will be? Robert? We have 7 million to begin with, and we have to put in an extra,
an extra 3 million.
exactly.
Okay, that's where I was disconnected.
That's it.
So that case, why you didn't take the average of assets?
Okay, that's a good question. So I was, so I'm going to say this was made at the beginning of the year,
Oh, okay.
but yeah, I agree with you. There is an issue. Okay. But accurately, it will be made at the beginning of the year, so it will count for the whole year.
Yeah.
Yeah. But you're right, that is an issue that we have to think about. Everybody get that question? I mean, I'm supposed to average, right? So I'm going to say that, okay, I did it at the beginning of the year, so it counts for the whole year. To make it easier.
Okay.
Okay, now let's do the RI, right? Let's go in here. So let's do the RI, first RI. For the RI, we have an income of 600,000, right? Minus the capital charge, which in this case is 3 million. Times 14%. Is that all right? This is the RI. $600,000 minus 3 million times 14% gives you 180. The second one is 560 stop there. Sure, that's okay. Yeah, the capital charge here is, 7 million. So in the second case, if you use RI, you say you put 7 million in there, you've got to get me 10% on that. Yeah? So you have to get me 700,000, but you're only getting me 560,000, so you're doing 140,000 less. If you go to the third one, you find that this is exactly 16%, so the residual income is 0. You're supposed to earn 16%, you're earning 16%, your residual income will be 0. Now, if you add the project, let's just do one of them, all the others are similar, but let's do if you add the project. Okay. If accept, because I'm doing it for A, Ri, what will be the income now?
To 10?
We're already making 600,000, you take the project, you're going to get
10?
1050, right? But you have to pay the capital charge on 6 million now. And the other ones are exactly the same. You add the income, you add the investment that increases the capital charge, you look at the difference.
So either A or B, if you're basing it just on RI, both A and B are preferable.
Yeah,
But if you do it just on ROI, only B is preferable. So no matter what, B should do it.
yeah.
No matter what, yeah.
Okay, so that's the main point, we'll get to that in 1 second. Okay, now that we've done the calculation, you see how this works.
That's of course borrowing.
So let's go down. So let's go back in here. Which firm, let's assume that you can borrow at this rate, right? So let me ask you, which firm is better off by accepting the project? Go back in here. Do you think A is better off by accepting the project or not?
Yes, you're making more money.
Yes.
Greater RI.
Is everybody okay that firm A is better off by accepting the project? This is the key point. I can go to the bank, borrow at 14%, right? And make 15% on this project. Yeah? So I'm making money, I'm borrowing from the bank at 14% and generating 15%. Everybody okay with that? So, which firm is better off? A is better off. What about B? Is B better off?
Yes.
Yeah, sure, they borrow at 10%, 8% and, 10% and they pay 15%, make 15%, B is better off. And what about C?
No.
C is worse off. Okay, so A and B better off, C worse off. Are you okay with that? So how do you think we should reward the manager? By RI or ROI?
My initial reaction is measure both and try to gauge.
Right, but within the context of this problem.
Does the person
All right.
paying out the money want to give out more money or less money?
Yeah,
The first way, only one person would get it,
right.
and the second way, both two people would.
All right,
Yeah.
because, you know, management is deciding how much the returns, how much the business
Right.
needs to produce. Otherwise, they just put the money in the bank and they're done.
In this case, RI, A is only having an increase of 30,000, but residual income's increasing 150,000 on B.
All right. Is it all right that in this special example, that RI is better than ROI? In this special example. Because if you give them on ROI, manager A, who can actually make money of this project, will refuse it because their personal income will go down. Is that all right, Rebecca? I mean, I just want to make sure that, you know, the point of this is that if you're rewarding based on ROI in this case, the manager of A will turn down the project.
ROI is going down.
Sorry?
ROI is going down,
Yeah,
but the overall income from is.
exactly. So, I want to come, we've got a long roundabout route to come back to this point, that the manager's incentives and the corporate incentives are not aligned in this case to ROI.
B will be going.
B is fine, C is fine. Both of them do the right thing, whichever one you give. But A is where we have a conflict, right? They should be accepting the project, but if you reward them based on ROI, they will not accept the project. Yeah? So, let's go back. In this particular case, it turns out that in this particular case, RI is better. So, the question, last question, is why is it that ROI, if you look out in the field, investment centers reward more by ROI than RI? The question is, what is it that is somewhat artificial in this problem that makes RI good and ROI bad? Yeah.
Rate of return?
Sorry?
The rate of return?
The rate of return?
The required rate of return.
Yeah.
Is it clear that in this class of problems, if you have the data set up like this, RI will win every time? Because ROI could change either way. But RI will always go in the same direction as the project.
But
If the project earns more than the cost of capital, both RI will go up. So you're always going to accept any project which earns more than the cost of capital if you reward based on RI. If you reward based on ROI, it's not clear. Because the project may earn money, but your rate of return will go down. Basically, the issue here, let me go back here and just explain in intuitive sense what is going on, and it's kind of obvious once we look at it. See, the project is earning 15%, is that all right? 450,000 on 3 million. Yeah? So the project is earning 15%. That's more than the cost of the capital, but it's less than their current projects. Yeah? So when you get a project between their current ROI and the cost of capital, they're always going to refuse it. I just want to pause here and make sure that makes sense. Yeah?
Say that again?
Okay. If the project lies between their current ROI,
If the project's
which in
ROI.
this case is 20%,
Right.
and their required rate of return, which is 14%,
So it falls in that
Yeah.
area between A and B.
they are always going to say no.
because it's a weekly ROI.
If it is above their current ROI, they're always going to say yes. But if it is below their current ROI, but above the minimum rate of return, they're going to say no.
You're gonna say no, you're gonna
Because
say no
it's
for using
the
the
overall
ROI
ROI.
method.
Yeah?
So if it's a
So
little
that's the problem with ROI.
bit, lose the ROI.
Divisions that are doing well will turn down profitable projects because it's not good as the projects they have already.
Lose the ROI.
Yeah? So in this setup, it's always the case that RI is better. But that's not true in the real world. Okay? So I want to go back and ask you, there is something slightly artificial in this problem. If everything is given this way, yeah.
Well, I see one thing, but wouldn't the minimum ROI be the same from one?
That is possible. If that still won't change this basic problem, right? All three will either do one way or the other. That's given. But this basic thing that the ROI could go down, but that the shareholder can be better off, would still be there. Your net income could go up, but your ROI will go down. Yeah. Maybe it's not so obvious, but the point about this is if there's only one project in all the world, there is only one project, and the manager has to decide whether to take that project or not,
Right.
then RI will always win. But if you want the manager to go out and find the best project, that's when ROI becomes better. You see what I mean? They're going to look for a high ROI project. This way they only have one project, this one project. If that is the world you're living in, then RI will always win. Okay, because it's very easy, they don't have to go look. But if you make the manager to go and look for a project, then rewarding them on ROI, they'll look and find the highest ROI project. So that's the real artificiality in this problem, that whether you want the managers to go and find projects, or you already know all the projects that are there.
So that would be the threshold to accept.
Sorry?
That would be the threshold for your search. You don't
Yeah.
accept projects that are ROI higher than the ROI.
Exactly.
The other case where ROI is lower than their original ROI, but higher than their interest rate,
Rate of return.
dilutes their,
They will lose here. Yes,
they dilute
they will lose. But in general, if you don't know what projects are out there,
the yes, no,
sorry?
the yes, no.
Yeah. So if you don't know that, then giving them an ROI the incentive to find high ROI projects might outweigh the loss from this way, right? Yeah? If there's a 25% project out there, you want the person to go look for it. Yeah? But if you know exactly what projects are already out there, then RI will typically win out. So the main question is whether you want the manager to go and locate high ROI projects, or you already know what projects are out there, and that's the issue that drives this. Any questions on this? All right. I'll finish off one more thing and then we'll go to the case. Actually, I'll skip this production efficiency measures. I want to tell you that there are other measures which are not financial. And I thought that, I put a couple of them in. I don't know if we'll have time to get to that. So here is one where we look at it. I'll just go quickly through it. This is in chapter 18 of the book. Now, I don't know if you're going to get there, but there are efficiency measures which are quite often used in terms of assessing factories and things like that. And I want to go to the end of what I have here. I just want to highlight it. I don't know if you'll have time to do this, but I want to tell you something first. Okay, this is the balanced scorecard issue. This is in chapter 18 of the book. Why?
Sure.
Have you done this in other places?
No, but we're about to, so we need to know this.
Kim's class, so.
Oh, good. Then I don't have to do it. Okay. But I want to tell you.
No,
that
go ahead.
No, go ahead. We haven't done it yet.
Chapter 18 of the book. It's in chapter 18 of the book. And the basic point about balanced scorecard is that you will mix financial with non-financial measures. Okay, so this is the basic idea. So what I wanted to give you, okay, let's just look at these simple things and then we'll go back and do this. Right? Southwest Airlines, let's look at the fast food, right? A fast food chain rewarded employees if they threw away very little amounts of chicken. Right?
That's a bad idea.
Bad idea?
Yeah,
For us.
Okay.
for the consumers.
Right. As a consequence, the employees stopped cooking chicken until a customer ordered it, making the customers wait a long time for their food. Because you didn't want to waste any chicken, you waited for the order to come in, which meant that everybody waited a long time to get their food, and you stopped eating fast food.
See, that's not what happens.
Okay.
Typically.
So this was,
They just actually what happens is they just let it sit under the heat lamp until it's tougher than leather.
all right. Okay. So anyway, this was one thing, and Southwest Airlines, this is another one that they feel that, they used to hire, I don't know, I haven't flown Southwest recently, but they used to have like entertainers on the flight. And I still remember one of them, we landed somewhere and it was a bumpy landing, and the captain pilot goes over the thing. There was a bumpy landing, but it wasn't my fault, it wasn't your fault, it was the asphalt. So, there you go. That was the idea of how to explain what was going on. All right. So, that's the strategy, but I want to go back and just look a little bit at some non-financial measures in a production context. It doesn't take very long, so let's do that. So here is a typical thing that you look at. Maybe it's in the book, maybe it's in the chapter 18. I didn't look, but it wasn't in chapter 14. So I put it's not in the book. So this is the basic thing. You look at this and you say, look, the customer order is received, then you have a wait time, you have a process time, you have an inspection time, you have a move time and a queue time. And the only value added time is the process time. And all these others are non-value added time because the product is just sitting there and you're not working on it. Okay? So the idea is to maximize your throughput time, which is the time you see here from throughput time, from the time you start the process to the time you deliver. That's called the throughput time, and that's a very standard measure of whether you're doing a good job or not. So they'll tell you to cut your throughput time down. Okay. So here, let's just look at the throughput time. If you look at it, it's the wait time to the start of production. That's the only one that's left out. It's here in the graph. So the throughput time is everything else except the wait time. So you can just add this up and you see it's 0.3 plus 2.7
It's 9
plus
total.
1.49. Right? 9 is your throughput time. Right? And then you want to see what percentage of throughput time was spent in non-value added activities. So this is going to be your move time.
2.7
Your
divided by 9.
move time is 1 day, plus your queue time is 5 days.
2.7 divided by 9.
Move time, queue time, and inspection time. So why inspection time is not value added, I'm not really sure. Maybe they think of it as, I don't know. Just make sure that, they think of inspection time as non-value added. Anyway, this is going to be 6.3 divided by 9, which is 70%.
Oh,
And if you look at the MCE for the quarter, the manufacturing efficiency, it's the value added time divided by the throughput time. So the value added time is 2.7 divided by 99, which is 30%. And the delivery cycle time is 20 minutes, 20 days from the time that is it 20 or 23, sorry.
14 plus 9 is 23.
Yeah, it's all the time, right? From the manufacturing cycle is what is it?
14 plus 9.
Oh, that was a 9.
Yeah.
9 plus
14.
23. So I don't want you to get too hung up on this. All I wanted to do was to give you some examples of this. I'll leave you to figure out part 5. But the basic idea here is that you have non-financial measures, and these are common ones if you're in a production unit. And just work it out from the definitions. What I would like to finish up is the River Beverages case. It's in your book, but you can keep. Just quickly go through this. This is a company which has 5 segments. In the vice president, 5 vice presidents. Each of them is there are 5 regions. Okay. Each of the regions has a vice president. There are 5 regions. Each of them has a vice president. Then each of them has a strategic research team. Each of them has a controller, and they have 3 segments: there's carbonated drinks, non-carbonated drinks, and food products division manager. So each one of these vice presidents has these 5 teams under them. Are you okay with the picture? Yeah? Every one of them has that one. Okay. So now, what they're asking for is how should we set these things up? Should they be particularly down here? Sorry, let's go over the next page. So each of these non-carbonated drinks division looks like this. They have a plant manager, a division sales manager, a controller, and then you have all these other managers underneath. And I guess the big problem, there are other little issues here. The real thing is, what should we set up? Should we set it as a profit center, a cost center? How should we set it? So we're going to go through that in this context of this problem. Okay. So what we need to do is, first of all, to understand how the budgeting process works. And after we're done with that, we're going to see whether it makes sense. What should be a cost center, what should be a profit center, and so on. Okay. All right. So, I got a bunch of questions here that just takes you through the mechanics. So I want you to start off, when does the budgeting process start, and what is the first step? So I'll get you started off on that. If you look on the second page, just under the picture, maybe I should pull the picture up. Give me a second, maybe I should go to that. So just take a look at the questions and look at the tape for a minute. You haven't had a chance to see it before. Okay, you see at the just below it starts at the beginning of December. The division manager submits a report to the vice president for the region summarizing capital sales. This is right under the second picture. Yep. So the start of the budget process is at the beginning of December, and the fiscal year is in July 1. Okay, so that's 6 months to prepare the budget. Okay, so they start at the beginning of December, 7 months. And the division manager submit a report to the vice president for the region summarizing capital sales. So that is the start of the process. Maybe you can look at some of the other questions while I'm just pulling this up. All right, so here we are. So at the beginning of December, the division manager submits a report to the vice president. That's the start of the budgeting process. Switch in here. First step, starts in December. Okay. And the division managers start the project. Okay, to the meeting here. So, how many regions are there? Who does the region? There are 5 regions, and each one is headed by. Right? Then how many segments are there? There are 3 segments, right? The three segments which are carbonated, what's the third one? Fruit juice or something like that. All right, so let's just stop there. So you have a basic idea of how this, the hierarchy of this company works. Forget about the questions for a minute. Who do you think should be setting the sales forecast for this company?
Regional people or division?
Vice President. Strategic research team. Where would you normally start the sales forecast? Sorry? Sorry.
I would think it'd be the strategic research, because they're looking at the market.
Market research? Yeah. So what are the 2 basic ways? I mean, the two, one way is you can make the strategic research team do market research and stuff. What is the other possible way you can do it? Sorry?
Based on the trend. They usually do it based on the trend. And if they know that there are any other projects, like one-off project, then they box up. Basically, the finance people in the field, in the regions, they know.
Okay. Okay. In this, you know, so where do you think the finance people would be in this company? I mean, who would be the equivalent in this hierarchy?
Usually, I mean, the preparers are just like a regular financial analyst, but.
Oh, you mean you go to an outside financial analyst? I'm sorry. Was that what you
No,
meant?
within the company.
Within the company? Yeah. Okay. So, given this, I mean, I think that the idea here is the so-called strategic research team is where that kind of person is working, right? The strategic research team. Okay. In a way, you can go. I mean, the point I'm trying to get at is that you can go from a high-level team analyzing the market, or you can start. Who else might be?
Oh, to go on trend. controller of the department. They would-
Controller of the department?
They would look and say, well, I can use this store.
All right.
So we bump it up every month.
Okay. All right. So let me again ask you the question I'm trying to get at. Who do you think really knows the most about the sales in this company?
Salespeople.
Right? And there's one other choice.
The district sales managers.
One could be, as you say, the analyst, the strategic analyst. The other possibility is the person who is
Selling.
down on the line, right? The actual salespeople. You know, here I think that the district sales manager, this is the top-down versus the bottom-up kind of budgeting. That if you want to start, you can either go to the people who are actually on the line and ask them for advice, or you can try and do some kind of strategic analysis at a higher level. So this is always the trade-off in all these things. Okay, now let's just go back to this firm. You find in this firm that the just switch back to this. Okay, so what they do is they begin with a high-level forecast, right? So the division managers start the process off. Okay, so each of the division managers predicts what will happen in their region to the region. Okay. Then the strategic research team begins a formal assessment of each market segment. And this is the kind of thing that we were talking about. They consider the economic conditions, current market share, and so on, and they come to this. Right? The point that really I think is interesting, at least to me in this case, is the next step, where when the corporate forecast has been completed, the district sales manager estimates sales for the upcoming budget year. So it looks like they're doing from both sides, right? From the top, they're doing an analysis, and from the district sales manager, they're doing another analysis. And I think the interesting part in this kind of case is what happens if the two don't agree. Yeah, and I think that that's sort of the point here. Okay, let's just go back and see who is really ultimately responsible for this. Yeah, right. That's the thing. Yeah. And that's the point, the little point I wanted to get through in the middle questions in that. When you look through this, you find that the direct sales forecasts are reviewed by the strategic team. Everybody reviews it, but ultimately, okay, where I had this.
Page 1.
The division sales manager is the one who is ultimately here. The district sales manager are ultimately responsible for the forecast they prepare. So what is happening here when you go through the forecasting process, they have some of the strategic analysis, they have something coming from the bottom up, but in the end, the final responsibility is on the district sales manager. Okay? This is very common in these companies. The question is, if the center, the real tension, and that's what's not very clear in this problem, is if the district center gives an absurd request, or what is the tension between the district sales managers and the center in preparing the budget. Okay? So I'll just return to those questions for a few minutes. What is the district sales manager? They help in forming it. Okay? And they are responsible what does this really mean is what I want to talk about. this in a way is a sort of central theoretical tension in this whole analysis. So what are the incentive problems with sales forecast? Suppose you go to the district manager, and the district manager is rewarded for meeting his or her forecast and penalized for going under. This is how it works. They're responsible for their forecast. They meet the forecast, they get a bonus. They miss the forecast, they get a penalty. So what would you do as a division manager? What kind of forecast would you give? High, low, medium?
You would want to give a
Not
low
too high.
forecast?
Not too high. And that is the basic point here.
So yeah, that means we can't be moving those goals.
Yeah? Yeah. And this is the basic problem that comes up in all these issues, that you want to get yourself a nice low target that you're sure to beat. So the question is, how do you fix it? So I just want to focus on that, and that's kind of the theoretical point in this case. So I want to ask you, so what is the incentive for the district as is rewarded for meeting its or forecast they will make? How do you think we fix this? There is a standard, this is part of the standard incentive theory of how you fix this. I want you to think about this. So you have this thing, you go to the manager and you say, look, you give me a forecast, you're responsible for it, you meet it, you're fine, you miss it, you're in trouble, now tell me what your forecast is. And you know they're going to give you something that is not all that high. So how do you sort of get them to give a better forecast that avoids the
So
problem?
you take away the penalty and you maybe make a graduated structure of, rewards as
Okay,
opposed to.
all right. So you could try something like that, you know. But what will happen if you take away the penalty? Sorry?
But if they do those well, if they don't, nothing, no skin,
Yeah?
no skin off the bone.
So they might give you a good forecast, but they won't have the same pressure to meet it, right? I mean, this is the tension. But you're right, I mean, you could try something like this. But there's actually another thing that people do. What do you think? Suppose somebody gives you a really high forecast, right? You know, I mean, what do you think you should do with them? Do you think you should reward them or penalize them? Again, I'm not, trying not to give away the answer.
But forecast
Can you think of a two-stage scheme? Let me put it like this. So,
You give them a
yeah,
number.
but forecast is
sorry?
forecast is created monthly, right? So they already know what they expecting to spend, and budget is doing yearly, right?
So, no way they can?
Forecast is usually they create monthly.
Right.
Every month they create
Right.
a forecast.
Yeah.
So basically they can be relatively close to the forecast, right?
Mm-hmm.
So for the budget it's a different story. It's a year trend, right?
Okay. So you come at the beginning of the month, you know December is a good month. It's easier to sell in December, but you give the November forecast anyway, same as last month, right?
No,
Ah.
I'm saying that basically when you're forecasting, you already know your expense because you already know all your projects because you forecast for the months in advance. Versus budget you forecast, you budgeted for the year, right?
Right.
So are we talking about budget or forecast?
For the biasing the forecast, you asked me, is it for the year or is it, a monthly forecast are harder to bias? Is that your point?
Yes.
Yeah, I think that's fair enough. You know, I agree again that, you know, in practice that biasing short-term forecast is a little harder because you'll be caught much more quickly, right? But I'm just taking in more generally that you have two stages, right?
This is how we do it.
Yeah, but this is done annually.
No, I'm just
And
saying
two,
in general, you know.
reward or penalize for meeting the forecast. Unfortunately, you kind of meet this to make them work after, even on a monthly basis. Maybe if you don't reward or penalize them, they'll make a forecast and then they'll, you know, go off on a holiday or something like that. I mean, they still have this this issue, that if they want to take it easy, they would be scaling the forecast downwards, but it's not as severe if you're doing it on a monthly basis as if you're doing it on a yearly basis. Okay? So there is an alternative scheme to this, and what they say is you first get rewarded on your forecast. So if you get a high forecast, you already get a bonus. And then that bonus gets adjusted based on how you meet or beat it. Okay, so this is again the traditional theory answer. That if somebody gives the higher forecast to begin with, they get a bigger bonus to begin with. Yeah? But if they don't meet it, you take away more of the bonus than if somebody who gave a low forecast. So this two-stage process is supposed to be the theoretical resolution of this. So the idea is you reward first for the forecast. And it could be indirect also. Somebody gives a high forecast, you say, all right, we'll give you more people to work in your department, we'll give you more resources. Let's see. Yes. So this is supposed to balance the tension that you give a less biased forecast and you're able to meet it, because if you bias your forecast, you don't get so much money, but if you bias it too much and give an unrealistic forecast, you're going to get penalized when you go to the end. Yeah. So this is sort of an idea that comes up constantly in this sort of situation. Okay? So the incentive problem that just said. Two-stage incentives. So this way, you are incentivized to try and provide a decent target, but at the same time, if you provide a stupid target and collect a lot of resources up front, you get penalized after because you don't meet it. Is that okay? Yeah. All right. Okay. I didn't find this very well. The sales department is primarily responsible for product price, sales volume, and delivery timing. It says that. And plant managers are responsible for plant operations. Okay, so this shouldn't really be a question. It should be part of the next one. So this is a bit of detail. So I just want to go back here. Should the plants be assessed as cost centers or profit centers?
Cost center.
Cost center? Okay. How are they actually being assessed here? So that's the next part. So after top management approves the plant budget, it's separated into a sales budget for each plant, right? This is the functionality that we talked about earlier. You have to tell them, this is what you have to do. This is you don't do this, it doesn't go any further. The budget is broken down further by price, volume, and product type. So they give all this. Plant managers budget contribution margins, fixed costs, and pre-tax income using information from the plant sales budget. Okay, so you get the sales budget, and then you as the plant manager forecast what you think the profit will be. Budgeted profit is determined by subtracting budgeted variable cost and budgeted fixed costs from the sales forecast. Oh, sorry. Operations and maintenance managers work together to develop cost standards and cost reduction targets for all departments. Budgeted cost reductions from productivity improvements, unfavorable variances, and fixed costs are developed for each department, operation, and cost center. Okay, this is a bit like what we talked about earlier, that they have this allocation to, fixed cost allocation differently, variable cost allocation differently. But the real difficult part here is that, let me see, performance measurement. Here. The basic thing you find out if you look through this, let me see if I can find this exactly where it says this, but basically the, just get out of here. Okay.
But you gotta deal with what's in the case.
Here.
I'm worried about this case. But this case.
The sales department is responsible for approximate sales volume and delivery timing. As you might imagine, problems between plant and regional sales managers occur from time to time. For example, rush orders can cause production costs to be higher than normal for some production runs. Another problem can occur when a sales manager runs a promotional campaign that runs a margin to shrink. Both problems negatively affect the plant manager's profit budget, but positively affect sales manager's forecasted sales budget. Would you be happy with this as a plant manager? Yes, no. No. Yeah, I mean, basically you're responsible for somebody else's issues, right? So when it comes down to this, let's go back to the, okay. So when you go back to this, okay, so the first part we just discuss each step in the budgeting process at River, begin with the division manager's initial report, what is the budgeting process like? Should plant managers be held responsible for costs or profits?